When you decide whether traditional or Roth is right for you, you have to first understand the differences between the marginal tax rate and the effective tax rate. Just because you're making $100,000 a year, it doesn't mean that you're going to pay all 22 or 24% of $100,000 to pay the federal income tax. You should know what your current marginal tax rate is and how your effective tax rate is calculated. And let me break it down for you. So your gross earnings are what you earn before taxes and deductions. If your hourly rate is $40 per hour, working 40 hours a week, then your annual salary is $83,200 and your monthly gross earnings are almost $7,000. And let's say you have healthcare, dental, vision, and other pre-tax expenses taken out of your gross earnings, and that leaves you $70,000 in taxable income. I want you to remember these two terms. You have gross earnings of $83,200 before taxes and deductions, and you have $70,000 in taxable income after deductions but before taxes. Then the next step you need to know is if you're filing your taxes as a single individual, a head of household, married filing jointly, or married filing separately, your tax bracket will fall in one of these depending on your life situation. And knowing your tax filing status will help you understand what your current standard deduction will be for the current tax year. For 2024, the standard deduction has increased by 5.4% from 2023. An increase in standard deduction means that you get taxed less every year due to inflation. Your $100,000 in taxable income from the previous year is going to be taxed 5.4% less than the year before. That makes sense so far, right? So the standard deduction for single individuals and married individuals filing taxes separately is $14,600. So the first $14,600 that you earn is considered tax-free. The standard deduction for married couples filing their taxes jointly is $29,200. If you're a head of household, your standard deduction is $21,900. The standard deduction is a figure that is set by the IRS every year that can be subtracted from your taxable income. And I will make an updated video every year so that you're all aware of what your tax situation is going to be. So for example, if you're making $100,000 a year as a married couple, then your taxable income in 2024 with the standard deduction is going to be $100,000 minus $29,200, and that's not counting any of the pre-tax deductions that I mentioned earlier. So your total gross earnings are $100,000, and your total taxable income is going to be $70,800 in this example. Your total taxable income could be a lot lower if you make or traditional 401k contributions, healthcare premiums, or health savings account. And if you're over the age of 65 or legally blind, you will get an additional $1,550 per person for the standard deduction, or $3,100 for married couples if you're 65 years old and or blind. And if you're single and or head of household, you're gonna get an additional $1,950 or $3,900 if you're both 65 and blind. Let me give you an example in this scenario. So if the husband is 65 years old and the wife is 65 years old and blind, assuming that they're gonna file their taxes jointly in the year 2024, their standard deduction is going to be $29,200 plus $1,550 for the husband for being 65 years old, plus $1,550 for the wife for being 65 years old, and another $1,550 for the wife for being blind. And that's going to come out to a total of $33,850 just in standard deductions for age 65 and older, and if one of you or both of you are blind. And their taxable income is going to be subtracted significantly with the increased standard deductions. And the standard deduction for dependents is going to be $1,300 or your earned income plus $450, whichever is greater. Just remember that the amount can never be greater than the usual standard deduction available for your filing status. Make sure to get with your local CPA if you're not clear about your tax filing status for your dependents. And these are the marginal tax rates for the tax year 2024. Remember that these dollars are for your taxable income and not your gross earnings. Your taxable income after you deduct the standard deduction or itemized deductions, right? Your taxable income is after you deduct the standard deduction or itemized deductions. So if you're single making $47,000 a year, your first $11,600 is taxed at 10%, and the next $36,000 is taxed at 12%. If you're married making $150,000 a year jointly, your first $23,000 is taxed at 10%, and the next $71,000 is taxed at 12%, and the remaining $56,000 is taxed at 22%. So your tax threshold is much higher if you're married and filing your taxes jointly. Because if you look at single individuals, head of household, and couples filing their taxes separately, your income between $100,000 and $192,000 will already put you in the 24% tax bracket when couples file their taxes jointly are still at the 22% tax bracket. That 2% difference really makes a big difference with thousands of dollars. And you could very much be in the 32% tax bracket if you're single or a head of household if your taxable income exceeds $192,000. But just remember that it is a progressive tax system. So not all of your $192,000 would be taxed at 32%. Your first $11,000 is taxed at 10%. The next $36,000 is taxed at 12%. The next $53,000 is taxed at 22%, and then the next $91,000 is taxed at 24%. And this is the 2024 tax bracket for single taxpayers. And let's assume that the income is $70,000 in 2024. The income thresholds for the marginal tax rates are going to increase every year to adjust for inflation. So your first $11,600 will be taxed at 10% or $1,160. And the next $35,549 will be taxed at 12% or pretty close to $4,300. And the remaining $22,851 out of that $70,000 income is taxed at 22% or $5,027. So your total effective tax will be $10,453, and that's how much you would owe to the federal government based on the 2024 numbers, making $70,000 a year in taxable income. And your effective tax rate is 14.9%. That's your effective tax rate or effective tax divided by your taxable income. Your marginal tax rate is 22% because that's the top tax bracket you're at, but your effective tax rate is almost 15%. And take a look at the tax bracket for married filing jointly. And let's assume that your gross income is $179,200. After the standard deduction of $29,200, your taxable income is $150,000, assuming that you have no dependents. So the first $23,200 is taxed at 10% or $2,320. The next $71,100 is taxed at 12% or $8,532. And the remaining $55,700 is going to be taxed at 22% or $12,254. So the total effective tax for this couple will be $23,106. And if you divide it by $150,000 in taxable income, not $179,000 in gross income, you're going to divide that by $150,000 in taxable income, it's going to give you 15.4%. And your marginal tax rate is at 22% because that's the top tax bracket you're going to be at as a married couple filing taxes jointly. And just to recap on the differences between marginal tax rates and effective tax rates, the tax brackets I just showed you are the marginal tax rates. Your effective tax rate is the average amount of taxes you're going to pay. Your W-2 employer is already deducting your tax from your paycheck based on what you selected on the Form W-4 if you're single, married, or head of household. If you're not withholding enough, you might end up getting penalized by the IRS when you file your taxes. Any additional taxable income on top of your W-2 income is going to be taxed at your marginal tax rate. It's important that you understand where you are in your tax bracket and how much you will owe if you receive a non-qualified dividend income, short-term capital gains, or real estate income. By the way, I am so fired up to announce the launch of my private FIRE community for people just like you and me who are passionate about investing, saving, and achieving financial independence and exploring different possibilities to retire early. My private community will allow you to connect with me on the platform and get in touch with other like-minded individuals or couples who are just as serious as you are with the FIRE movement. As a member of my private community, you'll get resources like investing, saving, paying off debt, or finding the right place to grow your money. So what does it mean when you make a pre-tax contribution versus an after-tax or Roth contribution? Let me give you some examples. For the pre-tax deductions, it means that these deductions are coming out of your gross earnings based on your hourly rate or your base pay. So the contributions you make to the traditional 401k is going to be in pre-tax dollars, which means that you're putting these dollars in the 401k before you pay your taxes. So every time you make a pre-tax contribution to a 401k, 403b, TSP, or other 401k type plans, what you're doing is essentially electing to pay into your 401k before you pay your taxes so that you can pay your taxes later when you start taking distributions from your 401k or 401k type plan. If you meet the income limits, you could do the same thing with a traditional IRA or individual retirement account. Just remember that your 401k and IRA are two completely separate investment accounts. Your pension plan is typically in pre-tax dollars. You have to talk to your company HR or read the pension benefit plan to find out how you're contributing to it. If you're a federal government employee, your federal employee retirement system or first pension contribution is actually in post-tax dollars, so keep that in mind. And if you're a military member, you actually don't make any pension contributions, but you will collect the pension when you hit 20 years in service. A health savings account, or HSA, is another investment vehicle where you can contribute pre-tax dollars. And what's awesome about the HSA is that it even allows you to skip your Social Security and Medicare contributions. That's what I call quadruple tax advantages. So not only do I get to defer paying federal and state income taxes with an HSA, but I can also avoid paying 7.65% in FICA tax, which includes 6.2% in Social Security and 1.45% in Medicare taxes. However, your state income tax in California and New Jersey are not tax deferred or in pre-tax dollars for any HSA contributions. So if you're a California or New Jersey resident, please keep that in mind. And for FSA, or flexible spending account, is also in pre-tax dollars. And that could be your dependent care FSA for your kids' daycare center, nanny, or summer camps, healthcare FSA for medical expenses, and limited healthcare FSA for vision and dental expenses. If you already have an HSA, you can do what's called a limited expense healthcare FSA, which covers the out-of-pocket costs for dental and vision. You just don't do the straight up healthcare FSA and HSA at the same time. And there's a difference between limited expense healthcare FSA and healthcare FSA. And I used to have an HSA and dependent care FSA at the same time. That's not going to be a problem at all. And the healthcare premiums, dental insurance, and certain term life insurance are also contributed before taxes. Your federal employee life insurance, or FEGLI, is actually in after-tax dollars, but the SGLI for the military is in pre-tax dollars. So keep in mind that all of these contributions will lower your taxable income already. Have you ever noticed that how you have a gross earnings and a taxable earning on your pay stub, right? Your taxable earnings are the dollars that are taxable after all of these pre-tax deductions. So if your gross earnings are $5,000 in this week's paycheck and your pre-tax deductions are a total of $1,000, then your taxable earnings are actually $4,000. So you're not taxed on $5,000, but you're taxed on $4,000 after all of these deductions. So let's say you contribute $20,000 this year and lower your marginal tax rate from 24% to 22%, saving you almost $4,800 this year. You have to remember that because you put money into your traditional 401k, you're going to end up owing taxes later on the pre-tax dollars you put into your 401k. You also have to remember that traditional 401k or 401k type plans are subject to required minimum distributions in your 70s, which could become a big headache if you have other taxable income coming in. So let's say you have $2 million invested in your traditional 401k. That $2 million is completely taxable, right? Assuming that you use the 4% withdrawal rule, and that's going to give you $80,000 a year in taxable income. Your marginal tax rate as a single individual in the current tax year would put you around 22% or 12% if you're a married couple. What we don't know is what our tax structure or marginal tax rates will look like in the future years. That's a gamble you're going to have to take if you choose to invest in your traditional 401k or if that's the only plan your employer offers. So, in this scenario, let's assume that you are 35 years old and single, making $100,000 a year. Your standard deduction for 2024 is $14,600. You decide to contribute $15,000 to your traditional 401k. Because you're delaying paying taxes on the traditional 401k, your taxable income is reduced from $100,000 to $70,400 after you take out the standard deduction and the traditional 401k contribution. That makes sense so far, right? So the first $11,600 will be taxed at 10% or $1,160, and the next $35,550 will be taxed at 12%, or it's going to be almost $4,200 or $4,300. And the next $23,250 will be taxed at 22% or $5,115. So the marginal tax rate is at 22%. 15% contribution you make to the 401k for $15,000 will save you $3,300 in taxes today, because $15,000 multiplied by 22% in the marginal tax rate is $3,300, assuming that you have 25 years until you turn 60 years old. With a 2% annual increase in inflation and 8% average annual return from the stock market, you should have about $1.4 million invested in the 401k by the time you turn 60 years old. So that 1.4 million in the traditional 401k is your taxable income when you retire. So let's fast forward 25 or 30 years into the future when you retire. And this example shows that you're going to retire as a single individual and not married. Let's assume that your Social Security pension income is $30,000 a year and your traditional 401k is about $40,000 a year with $1 million invested using the 4% withdrawal rate. So your retirement income is 70% of what you made when you worked with $100,000 a year. Because you contributed to the traditional 401k, you delay paying taxes on your 401k contributions and earnings. So your total taxable retirement income will be $70,000 a year. And I'm going to use the 2024 tax rules. So your standard deduction is going to be $14,600 as a single individual. What this means is that the first $14,600 you earn from retirement is going to be tax-free. You start getting taxed at $14,600 and first dollar. If you're over the age of 65 and or legally blind, your standard deduction will be even higher. That makes sense so far, right? So the first $11,600 of your taxable income will be taxed at 10%. And then the next $35,550 of your taxable income will be taxed at 12%. And the remaining $8,250 of your income will be taxed at 22%. So the total taxes you will have to pay under the 2024 tax rates is 7241. If I divide it by the taxable income, it's going to be about 13.1%. But the marginal tax rate will still be at 22%, which is the highest marginal tax rate you will have to pay with $70,000 a year in retirement income as a single individual. The biggest factor is that you're retiring as a single individual. And I'm not by any means saying that you should get married to lower your taxable income, but that's just how the IRS sets the tax brackets. And if you're looking to retire as a single individual and you don't want to pay any more than 12% in marginal tax rate, that $8,250 right there, or right here, you will need to come out of the Roth savings. Otherwise, your marginal tax rate will still remain at 22%. It makes sense because you'll be paying $1,815 out of that $8,250 to the IRS. Using Roth just for that 22% portion could potentially save you thousands of dollars in taxes in retirement. And keep in mind that these tax rates are assuming that you're retiring in 2024. So the inflation adjustment is going to put these tax brackets much higher. And the only unknown factor is that Congress could completely revamp the tax system by then. So who knows what will happen in the future, right? So to me, if I were to retire as a single individual based on the current tax bracket, it would make more sense to me to use a Roth to pay my retirement later on. This is a very generic scenario, so make sure to run your own because your tax situation could be much more complicated because your pension income could be higher or lower depending on your current income. Let me give you one more scenario. Let's say you're going to retire with a Social Security income or pension at $30,000 a year, and you have a sizable amount in your traditional 401k with $93,500, with $29,200 in standard deduction as a married couple filing taxes jointly. $123,500 would be the maximum to maintain the 12% marginal tax rate. So based on the 2024 marginal tax rates, the first $94,300 is taxed at 10 and 12%. So your effective tax rate between the two would be 11.5%. And the people who plan for retirement know that the first dollar of $123,500 is taxed at 22%. Again, this is based on the 2024 tax rates. These dollars will go up because they will be adjusted for inflation every single year. And it could be $126,000 next year or maybe $130,000 in the year after. So is it a big deal if you slightly go over $123,500? Not really, because you're just going to be taxed 22 cents for the $123,500 first dollar, right? But if you think you're going to have significantly more income during your retirement and you only invested in the traditional portion of your 401k, then you could use a Roth IRA to supplement your retirement income. Maybe using a Roth IRA could prevent you from going 22% to 24% or from 24% to 32%. And just remember to ask your employer if they offer both traditional and Roth for your 401k. If you're close to your retirement age, maybe traditional or pre-tax is right for you. It really depends on your entire financial situation. Maybe you're going to have a lower tax rate when you're retired. And these are the things that you're going to have to reconsider or maybe consider when you're planning for your retirement. So what do you think is better? Investing $500 a month, making 10% return, or investing $1,000 a month, making a 7% return on investment? You can't figure out how much you can invest without a budget. There's no way around it. I personally tested out the budgeting app called YNAB, and it's not just an app that can track your income and expenses, but it can even help you create a plan to pay down your student loans, car loans, personal loans, or credit cards a lot faster. So if you're ready to change your life by getting out of the paycheck to paycheck cycle, you can get a free trial without any credit card information by using the link in the description below. Let's talk about the Roth 401k. Is it really the best option? Just because I invest in Roth, it doesn't mean the Roth is the right option for you. It is going to depend on your current tax rates, your time horizon to retirement, and your projected retirement income. I'm going to do some comparisons between how you're taxed now and how you save money on paying taxes later on in your retirement. So let me run some scenarios here. I'm going to first do the single individuals, and then I'll do the married couples later on in this video. Let's assume that you're 35 years old and single, and your gross income is $100,000. And after your standard deduction of $14,600, your taxable income is $85,400 based on the 2024 tax brackets. So the first $11,600 will be taxed at 10%. The next $35,550 will be taxed at 12%, and the next $38,250 will be taxed at 22%. For the Roth 401k, because you're paying the taxes on the contribution now, you want to assume that you're paying at the highest marginal tax rate. The income scenario shows at 22% marginal tax rate. So let's say that you're contributing $15,000 to your Roth 401k. Multiplying that by 22% in the marginal tax rate is going to be $3,300. You're not going to get billed for this or anything, but you're essentially paying $3,300 upfront to the IRS when you make the Roth 401k contribution because you're paying your taxes upfront. But what's awesome about the Roth 401k is that the money you put in will also grow tax-free, and then you can withdraw your contributions, earnings, and interest tax-free starting at the age of 59 and a half. So assuming that you're 35 years old and starting with $15,000 a year in Roth contributions every year with a 2% annual inflation increase in contributions, you could grow your Roth 401k to over $1.4 million in tax-free money if the market performs an 8% average annual return. So what can you do with $1.4 million in tax-free money? Well, keep in mind that I adjusted the Roth 401k with a 2% annual increase in inflation. So assuming that your Social Security pension is $20,000 a year and you have some traditional 401k with over $41,000 a year because you have your employer match that went directly to the traditional portion of your 401k. So your total taxable income is $61,750 and your standard deduction is $14,600 under the 2024 tax bracket. Obviously, the standard deduction will increase with inflation in 25 years. But for simplicity's sake, I'm going to use the 2024 tax brackets. So the first $11,600 will be taxed at 10%, and the next $35,550 will be taxed at 12%. And most retirees would like to pay less in taxes in retirement. So the 12% marginal tax rate is a good target rate for someone with $60,000 a year in taxable retirement income, because every dollar after the $61,750 will be taxed at 22%. But does it really matter if you go over $1, $5, or $100? Not really. It will matter more when you hit $1,000 in the 22% marginal tax rate, in my opinion, right? So if you want to retire with $100,000 a year and pay 12% in marginal tax rate, this is where the Roth 401k comes into play. Using the same scenario with $1.4 million invested in the Roth 401k, the 2% withdrawal rate would give you $28,000 a year. A 3% withdrawal rate would give you $42,000 a year. And a 4% withdrawal rate would give you $56,000 a year, depending on how your portfolio is diversified and grows annually. So with $61,000 a year in taxable income and $42,000 a year in tax-free income, that's over $100,000 a year in retirement income. In 25 years, that's all going to be adjusted with inflation. Assuming that the Tax Cuts and Jobs Act, or TCJA, remains in place with the current tax rates past 2025, you have to remember that the tax rates will get lower and lower because the IRS is adjusting it by inflation every single year. The threshold for the marginal tax rates will change every year. The standard deduction will also increase every year. However, if Congress decides not to extend President Trump's Tax Cuts and Jobs Act from 2017, which ends on December 31st, 2025, then the marginal tax rates will go back to the previous levels. The first tax bracket will remain the same at 10%, but the second bracket will change from 12% to 15%. That's a significant increase. The 22% bracket will change to 25%. The 24% will go back to 28%, and 32% will go to 33%. And 37%, if you're in the top marginal tax rate, it will change back to 39.6% like it was in 2016. I don't know what Congress will do in 2025, but it's going to depend on how Congress negotiates with the White House going into 2025 and how everything goes in the election, depending on when you're watching this video. So what if you're retiring as a married couple filing your taxes jointly with both a traditional 401k and a Roth 401k? Assuming that you're married and filing your taxes jointly during your retirement, let's say you're going to collect $25,000 a year for each spouse from Social Security and $40,000 a year combined from your traditional 401k and your spouse's traditional 401k. Your total gross income is going to be $123,500, and I'm going to use the 2024 standard deduction for married couples, which is $29,200. So the first $23,200 will be taxed at 10%, and the next $71,000 will be taxed at 12%. your total taxes are significantly lower than the single individuals and heads of household. Your gross income of 123,500 will only put you at a 12% marginal tax rate, and the first dollar after 123,500 is taxed at 22% for the year 2024. So if you and your spouse feel like you need more in retirement, you could use your Roth 401k to supplement your retirement income to maintain the 12% marginal tax rate. That 1.4 million is completely tax-free after the age of 59 and a half. Just withdrawing 2% would give you 28,000, 3% would give you 42,000, and 4% would give you $56,000, right? So that's pretty incredible just in the Roth dollars. That's all maintaining the 12% marginal tax rate. How incredible would that be, right? And most of you watching my videos on somewhere between 22 and 24% in the marginal tax rate. Is the Roth 401k contribution always right for you? Not necessarily. I would strongly argue that if I am close to the 32% marginal tax rate or at the top end of the 24% marginal tax rate, then I would strongly consider mixing both traditional and Roth to bring the tax rates down to 24%. And I strongly encourage you also to get with your CPA or whoever does the taxes for you. And you can always schedule your first session with me by visiting firestation.com/consultation. You can use the tax calculator to find out how much of your contribution can reduce your taxes now by splitting the taxes. If you decide to do both, keep in mind that the 401k contribution limit is a combination of both Roth and traditional. If you invest $15,000 in your Roth 401k, then you can only invest up to $8,000 in your traditional 401k if you're under the age of 50 in the calendar year 2024. And something else to consider is the state you're going to be retiring in. Does it come with the state income tax? And some states won't tax your traditional 401k distribution, so be sure to look that up in your state website. You should also consider your retirement age. If your time horizon is like 20 or 30 years, you should calculate to find out if your interest and earnings will outgrow your annual tax breaks. You can download my 401k calculator for absolutely free by visiting firestation.com/resources. You should also keep in mind that you can't shelter tax breaks forever inside your traditional 401k. Every traditional account comes with what's called a required minimum distributions, or RMDs. Your Roth 401k does not come with that. And most of you would have to start paying taxes on your traditional 401k in our 70s, right? And you can avoid the RMD by converting the traditional to Roth after you retire from the workforce, but you have to remember that you will owe income tax at the time you make the conversion. And if you're married and filing your taxes jointly, don't just calculate your retirement income, but also calculate your spouse's retirement income. But even if your spouse is unemployed, your spouse could still contribute to what's called a spousal Roth IRA. You can essentially double your Roth IRA contributions and increase your tax-free income. The bottom line is that investment accounts like Roth 401k, Roth 403b, or Roth TSP will allow you to grow those dollars tax-free after making your Roth contributions. And I would even argue that some high income earners in their 30% still need to put some money in Roth because those people will have the same or slightly higher income. And this has been another beast of a video, and I hope you got a lot out of it.